How's it going, viewers? Welcome to yet another episode of Devil May Crypto. Today's going to be possibly the most important video I'll ever make, and probably the most important video that you'll ever watch. Why? If you're not already a cryptocurrency investor in a Bitcoin and other altcoins, I'm going to try to convince you to become one. Right now, our current monetary system in the United States, I believe, is doomed to fail. I'm going to try to explain in detail on why that is and why moving into the crypto boom is possibly the best decision you'll ever make. Do you want to become wealthy? Do you want to never have to worry about money ever again? This is something that'll start your search off. It'll be something that gets you thinking. Let's go on this adventure together. So one of the things I just want to get across as soon as possible is the sheer amount of people that have told me, hey, if you're invested into Bitcoin and all these other digital currencies, what gives them value? They're nothing. They're just made up fake money, play money. They're like monopoly dollars just on a computer. Yeah, okay. What gives anything value? It is the fact that people want it and they believe in it. They trust it. Just like the dollar. So what gives the dollar any sort of value? Most dollars actually, in fact, don't exist in the first place. What do you mean they don't exist? They're on computers. So on computers, generally, most of it is debt. We'll go over that pretty soon. But I want to say, what I want to get out the way before we really dive deep into it, is that value can be put into generally anything. Anything can have really value in it as long as people want it. Okay? Bitcoin and other altcoins are just as real as a dollar. A dollar is simply a piece of paper. Okay? There's no intrinsic value to that piece of paper except for whatever value that it was worth the day before. You know that a dollar can pay for one McChicken sandwich yesterday. But no, when I tell people, they're like, it's backed by gold. It's not backed by gold. They got rid of the Bretton Woods system. There's nothing backing it up. Eventually, the dollar moved into, after it was taken off the gold standard, when you can basically exchange value from the dollar to gold. That was nullified in the 70s, in the Nixon era. Then they went to the petrodollar eventually. They worked with Arab nations, and they eventually made the dollar become interchangeable with oil. So oil was the standard for paying for oil was the dollar, okay? And energy is a very, very large business, especially for automobiles, for everything. Oil was a very integral part to the petrodollar. You can, if you have never heard of that system, I'm not going to get super deep into it today, but we are in the petrodollar system currently. And what that did was the same thing that basically, if you're in the cryptocurrency world right now, it's the reason why Bitcoin is worth so much nowadays, because everything initially, now you can use some other ones, but went through Bitcoin. To buy other currencies, you went through Bitcoin. Bitcoin was a standard that was traded with. So you would take the American dollar, change it into Bitcoin. You would exchange it, use a certain exchange, and then from Bitcoin, you can use any single type of, you can exchange for any type of altcoins. Every single one you can be traded off Bitcoin. That's what America did with oil. So if China wanted to buy some, or Russia, whoever else at the time, at least within the Arab nations, the one that produced possibly the most oil, at that point, they had to go through the dollar. So the dollar was more wanted, okay? There was more demand for the dollar, which basically made it worth more. It made it the gold standard, okay? So the dollar was like the worldwide currency that was like, it was backed by the demand for that oil too. So if people needed, they needed the dollar. And so I want to get that across too, but basically saying that anything in this world can have some value in it. It doesn't have to be, the tangibility of it isn't necessarily the most important thing. I mean, look at Look at probably one of the biggest companies in the entire world, Google. What is Google? It's a company. Google is an algorithm. Just sit there and think about that. There wasn't anything real about Google. Is simply an algorithm, and that turned into it's a search engine. And using an algorithm, it finds things. So all it is a bunch of binary. It's code, just like cryptocurrencies. But Google had value, and now it is what it is today because of the algorithms that it had. Okay, so it was just mathematics at its core. Think about that. On to the next thing. Here behind us, we have what is called the Federal Reserve. This is where a lot of our story starts. A lot of what we're going to be speaking about within monetary policy is going to revolve around the Federal Reserve. One thing I want to get across, what a lot of people don't realize, is kind of a misnomer, but the Federal Reserve, it's not the government. The Federal Reserve isn't a branch of the government by any means. It is private. Okay, I'm sure there's a little more ties, but in a general sense, we're going to consider it private. It is owned by some of the biggest banks in the United States. So ownership, it's run like a business. Ownership goes to the other businesses, which is the banks. So the banks in themselves, all of them grouped together, or some of the largest ones together, is basically the Federal Reserve. That's where the ownership lies, is within those big banks. So I want to get that across. The Federal Reserve is not part of the U.S. government. It is its own entity. Okay, let's keep on trucking here. We're gonna get real deep in a second. So this is where I gotta prep myself for this. This is where it all really goes wrong. Okay, initially, it all starts with a government, and it just goes on from there. Okay? This is the part I really want you guys to focus on. Initially, you might not get it, but just replay it a few times, and it'll start clicking in your head. So first, this took me a while too when I first learned about it, but Congress and the president make a decision of raising the debt ceiling. First off, I just want to say the debt ceiling will never ever go down. It will actually exponentially rise forever. The government will never, or our nation, whatever you want to call it, our nation will never realize that debt. It will never get to that point to where we paid it off. There's simply more debt than there is money, which I'll explain a little more later. But the debt, the ceiling will go up every single time it possibly needs to. It'll just keep going up. They'll never not raise the debt ceiling. It can't happen. It won't happen. The debt ceiling will go up. It's just what happens. So, starts with the Congress and president raising the debt ceiling, giving basically the Treasury the power to make some moves. What the Treasury does is it creates bonds. If you're an investor, to you, bonds are a very safe place to store your money. Okay, as you've been told. It grows over 5 years, however long that specific bond is for, but it grows over time. You get paid back that plus interest. Okay, it's not the best way to make money in the long term. I mean, there's riskier ways. It's known as the most low risk investment, but to everybody, I want you to think of it as a big IOU. Okay, it is the government giving the Treasury the power to write a big fat IOU to the people. They're basically taking that value from the people, and they're making this IOU, which is the bond. Okay, and eventually, you'll see how the bond moves. But so this Treasury bond goes to the commercial banks. It gets auctioned off to them. Okay, or these Treasury bonds. The millions and billions of dollars. It's going to be very easily trillion upon trillions. Very very soon, but. This vast amount of money gets auctioned off to banks. Your banks like Wells Fargo, JP Chase, Citigroup, whoever else, but the largest banks. And so once it goes to them, they basically are an intermediary between the Treasury and the Federal Reserve Bank. Okay, we already talked about the Federal Reserve Bank, okay, which is already owned by the commercial banks, but you'll see how they play a little like magic game with these bonds basically. So these bonds go to commercial banks. Commercial banks profit off of it, okay, because it's sold at a different price. So they've already profited off of these bonds, which have been auctioned, okay. Then it goes to the Federal Reserve Bank. Federal Reserve Bank takes these bonds, and they write a check. The Federal Reserve's like, oh, okay, yeah, hey, we got this bond, so let's, I'll give you guys a check for, $50 trillion, however much money it is, and that money comes out of nowhere. Money is made from thin air, okay? So it started with them raising the debt ceiling, and then it went to this point to where the Federal Reserve gets these bonds and just makes money out of nowhere. It just, generates out of nothing. Okay, from there, it goes back, okay? It goes back to the commercial banks. Well, I want to say we'll go over this part in just a second here, okay? But it goes back to the commercial banks, and like I said, the commercial banks are the middlemen, just like they are for the people. Commercial banks are the middle of everything. They're the ones that want to make things happen between two parties. They want to be the intermediary, okay? And they are, even on a large scale. So it goes back, these treasury bonds, they basically go back, and finally go back to the treasury, and that system, closes on itself and gets paid back, plus well, it's not the bond itself, but the value goes back to the treasury plus the interest on it, okay? But where it really goes awry, besides just making the money in the first place, is what the banks do with the money in between it, okay? And we'll talk about that in just a second. So, fractional reserve banking. What is it? Let me tell you about what happens with the money that, first off, banks take in. And this is from any money that gets taken in, whether it's from the reserve, from the treasury, whoever else. Banks can do this as long as they have some sort of deposit, okay? But generally, let's use people as an example, okay? Money gets deposited. Let's say, in this, it's $1,000, okay? Out of that $1,000, the bank can they reserve $100 out of that entire $1,000. What does that mean exactly? So if they only keep 10% of it, which is mandated as 10%, it does go lower. But right now, we'll just keep it at 10%. We won't go too deep into it. But they keep 10%, and the rest of it is play money, okay? So the only value they keep of that initial deposit is 10% of that. The rest of it goes out into an investment, a loan, okay? That loan, so as we see in this graphic here, the deposit goes in there, $1,000 into the bank. The reserve is 100, the loan's 900, and so the bank has that. They loan that 900 to a person, okay? And now that's just the first step here. So you have actual value go in, or let's say there's the genesis of that $1,000, but this value of $1,000 going in goes to this bank. The bank keeps $100, okay? And then the rest of it goes out. But this person still has, his $1,000 that they need to account for, okay? So his $1,000 still needs to exist, but they're only reserving for his $100. So if he goes to the bank the next day, let's say it's a closed system and only this person exists, he can't get his $1,000 back. They've only kept $100 of it. And what they do is fractional reserve banking just means they can take small portions of it, and it just basically exponentially grows from there. So that $100 is kept in the bank, $900 is lent out. And at this point in the system, there's $1,900. The bank only has $100 in it, okay? But within the system, there's $1,900 because that guy has $1,000. And that other person has $900 and the bank has, so you see where this is going, and it goes from there, okay? It's only the first step. It hasn't gotten too awry yet. Then that person takes his money, the $900, he goes to a bank and deposits it, okay? we'll say, basically rinse repeats. So a lot of times it's businesses going through it. This is a very broken down version of it with people, but it can go in multiple ways. And the value can, it could be goods and service exchange, whatever else. But basically, in essence, it gets deposited again. So that person takes that 900, deposits it. They reserve $90 and they loan out $810. Okay, that $810 goes to another person. Okay, so the only thing that happened, what I want to mainly say, is that within this system, because there's debts out there, now there's $2,710. Okay, so you see how this is growing. The value, the debt has, whatever type of value you want to say it has, but within this system, $2,710 exists. Okay, then let's do it one more time. So that $810 goes into a bank. They reserve $81, and then $729 is loaned out to another person. Okay, now within the system, there's $3,439, and the bank, let's say it's even the same bank. It could be different banks, but this bank, let's say, we're going to say the same one, it has $271. Okay? This person, this man, his $1,000 within the system of banking in fractional reserve turned into $3,439. And it goes from there. It just creates more and more debt. So if there's enough credit out there, there will be enough debt. The debt just piles up. And so it gets very murky from that point on, but it keeps going. And what happens is within this system, more and more money floods the market. Since so many people believe they have money and they're spending money, so even if you keep $1,000 in the bank, you can spend more than you have if you have credit. So everybody's spending money, and the only actual assets that are in there is a portion of what they have. The money comes out of nowhere. So first off, this money was created in the first place magically. And then on top of that, this money is fractionated between different banks, and it just stems down again and again and again until it turns, let's say it goes 10 times over. It can keep going, but let's just say it goes 10 times over. That 1,000 turns into, $10,000. How's that going to get paid back? You gotta ask yourself these questions. But I just wanted to show you how quickly $1,000 can get bastardized. And because more money floods into the system, if you saturate the market with money, the currency gets devalued. Because that currency, it's supply and demand at the end of the day. There's much more, just like in any other country, inflation causes the money to devalue itself slowly. Okay, but on top of that, since there's more money out there, things get more expensive. So you're borrowing money. As you're borrowing that money, you're creating more money in the system because of fractional reserve banking. And then things get more expensive because people are like, there's so much dollars out here, we got to take more. But the thing about it is that you didn't have that in the first place. Okay, so you're overpaying for things that only have value because of the lending that's happening in the entire system. And there's interest on that money. So what happens is your money is devalued, you're trying to pay it off with this and it's not even worth as much, and it's garnering interest over time. And everything else you're paying for, your shoes, your meals, whatever else, is getting more expensive too. Let that sink in for just a second, okay? Sorry if I want you to see like the rest of that. I'm gonna get out the way for a second, but because I got a big head. But I just want to get that across. But we'll go over more in just a second some of the things that really irk me. So in this video, we went over quite a few things so far. The collapse of the Bretton Woods system by Nixon, which was the exchange of U.S. dollars to gold. And basically that happened, the main reason for it is pretty much to save our gold reserves. And then past that, we went to the petrodollar system. Aside from that, I already talked about how money is made and how our monetary system kind of works and how it's introduced into the system and how it affects all of us. Within that, our growing national debt that we'll never catch up to, which is also made worse by the fractional reserve banking. That's why it exponentially increases. And most of the money has no value within it that's in our economy. There's nothing necessarily backing it up on top of on top of whatever trust or faith we have in the dollar. Most of what is on books is just debt. It is money made up out of nowhere. So as I say that, I want to really lead back into the petrodollar statement. Because the American dollar is very similar to Bitcoin right now in terms of, not necessarily similar, but in terms of everything has to be converted to the U.S. dollar to trade for oil, at least in a lot of Arab states, which is where most of the oil comes from anyway. So it increases demand for the U.S. dollar. Okay, in time, relations will become strained, regimes will change, powers will change, history will happen. As it moves along. Well, I guess the present will happen, but we've seen things happen within history, and along with that, what's going to happen is if the petrodollar system crashes, and there's already certain nations going against it. Venezuela, Russia are trying to stop it, but if that happens, it'll have pretty catastrophic effects on the United States economy. Will it completely change everything about the fiat system we have now? There's no way of knowing. I don't want to get too speculative. I don't know if it'll completely crash or collapse the dollar. If we'll all be turned to cryptos at that point, or if we'll have some other stuff. I mean, who knows really what'll happen? But I think it will not be good. I mean, it'll definitely lead to a recession at least. And then it'll definitely have long-term effects too. But I'm not going to sit here and try to indoctrinate you with worst-case scenarios. But what will happen is that the dollar will devalue to some extent, and it'll have a snowball effect in our economy too. In the midst of that, I urge people to hedge their bets with cryptocurrencies, which are decentralized and borderless as we move towards easier transportation, communication. The trend towards globalization will increase dramatically. So right now, the hegemony that the United States has when it comes to the dollar, it is pretty advanced. We're definitely there, but every fiat system will eventually end. If you look throughout history, how long America's been here is a very small scope of time. Nothing bad will happen to America. But what I'm saying is the system will change. Every business, every government, every business has to change along with time. This is not the collapse of the United States. It is not the collapse of democracy as we know it. But it will be a different way of keeping value on things. And I think the trend is towards cryptocurrencies, which I'll go about in a second into explaining. So here we are back with Bitcoin and the rest of the crypto talks here. I want to wrap this video up simply by stating it is very, very important and very wise to diversify between all markets. Just like you have some money, you have some equity in businesses, you have some bonds. I highly advise everybody to get into Bitcoin and other cryptocurrencies. And not necessarily currencies themselves, but things like platforms like Ethereum and everything else. Which, if you want to go to my other videos, I talk a lot about the other ones. Neo being one of the biggest ones, or nulls, for that matter. But those are other conversations. What I really want to say is decentralization will be the future. The centralized governments make mistakes, and it affects the value and the power of the currency that's within that system. Okay, you look at big government bailouts. You look at what happens in banks. You look at Greece. You look at Venezuela. You look at hyperinflation, and your hard-earned money will not always be worth the same thing. It will at times be worth much, much less than it actually is. So what I really want to say here is, you want to take that risk and simply diversified into something else. Right now, we're in the baby stages of cryptocurrencies. Bitcoin, even though it's gone up to $20,000, it's still in its infancy. You might not think something that's worth, probably was it $10,000 today. You may not think that's in its infancy, but it is. I project, and I don't like to make speculative, projections or bets on something, but you'll be able to buy a house with one cryptocurrency coin. I mean, how big the house is, it'll matter on what year it is. But it will be a store of value, and it does carry value within itself. Just like I explained in the beginning of the video, anything can really have value in it if people trust it and if people believe in it. There are many projects out there that are not currencies themselves, but they are businesses. They are a bunch of people working together to solve problems. Platforms that incorporate smart contracts, and the grasp of what cryptocurrencies can do and what distributed ledger technology can do, or the blockchain, is vast. It can complete. The reason why I think banks are so afraid of it and why they're trying to learn about it and why they're probably trying to incorporate it is because it gets rid of them. They are the middleman, is basically what happened, what we talked about in the beginning of this video, is that they take money and exchange it from one place to another, and they get their worth out of it. With smart contracts and with the necessarily how easy it's going to be to make something from person to person, or a lot of like I said, within the area of smart contracts, well, it'll make things automatic. You won't have a need for those intermediaries. So it'll be something that happens in the future. We don't know if it's this year, next year, or whenever, but hedge your bets against it. You always want to have something diversified in a different field, and that would be my advice to you. The next step is learning a little bit more about it. Take a class, research online, watch videos. I have some other videos too, but there's plenty of other ones out there. Doug Polk Crypto is one of them, Blockchain Brad, Box Mining, all very, very smart guys. They're all doing it very, very well. But this is my promise to you. If you make this decision, it will be a wise one. I want to wrap this up by saying I'm not a financial advisor. These are all my opinions. So take them with a grain of salt. I've been an investor for years, and I do believe I have some entertaining thoughts and aspects that I can share with you guys. But always invest at your own risk. Do your own research, and I really hope that this revolution, this technological revolution that's known as cryptocurrency, treats you very, very well. I want to say thank you, everybody, for watching. Please subscribe, like, and comment. You guys are the best. I hope you enjoy the video.
Tell me pretty lies, look me in the face, tell me that you love me, even if it's fake.